Joining us now, we've got Marc LoPresti, CEO and Senior Market Strategist, Market Rebellion. Marc, good morning to you. Thank you so much for joining us this morning. Before we kind of talk trade and where we are in those kind of policies, because I feel like that has kind of helped the markets this past week, I want to get your take on the big headline that has been, it seems like, rattling the equity market this morning. Moody's downgrading the nation's credit rating from the Sterling AAA rating. I mean, they're the last of the three major ratings agencies to do this. How meaningful is this for markets?
Well, Dan, I hope the markets realize that this is the political stunt that I believe that it is. I mean, when you say that they're lagging their two brethren in the rating agencies business, you're talking, of course, about S&P and Fitch. We're talking 2011 and 2023, respectively. Let's put that in perspective for a minute. It took Moody's this long to decide that it was time to make this type of a change to the U.S. credit rating while we have this bill that's being debated that went again to a vote last night, while we have this budget package that's pending. This is absurd. These are the same guys that were willing to put a credit rating on a highly questionable mixed bag of mortgages that led to the financial crisis, for which there was no consequence. My hope, Diane, is that traders see this for what it is. We have a little sell-off this morning, and then we get back to the business of the rally.
I hear what you're saying about other missteps, but to be fair, the nation's debt is piling up. They flagged that the $36 trillion. I mean, could it be that they wouldn't be doing their job if they didn't acknowledge that?
Listen, I am not taking this position in any way to suggest that we don't have a massive, massive debt problem in this country. And it is not the fault of any singular administration. It's been the fault of many subsequent administrations from both sides of the aisle, letting this continue, letting it get worse, letting it pile up. There's that famous debt clock, as I'm sure you know, Diane, in Midtown, that shows the amount and how much each of us are personally responsible for. Something's got to be done. No doubt it's a massive problem. It's probably the biggest issue, one of the biggest issues facing the economy in the short term and in the near term. But to do this now, the timing, it's just so suspect. And I'm sorry, this firm lost all credibility with me back in the financial crisis. They just did.
Yeah, I know that debt clock that you're speaking of, and I know sometimes people make jokes about online saying, "Who do we owe the Decepticons?" Let me ask you this: does this? I mean, in terms of what I've been hearing from different analysts, the view is that this is not going to be, and even given where futures are, it's not going to be as rattling as when S&P first downgraded the U.S. credit rating back in 2011. Maybe we'll see something more like 2023. Does this change the conversation in Washington, in your view, at all?
Well, and that's the funny, ironic, and possibly tragic part of the story is I don't think it does because, Dan, you're a journalist, and I would ask, where's the news in this, right? I mean, and I think you put it very aptly that they're flagging the problem, they're indicating the amount of the debt, they're indicating what the amount of the debt service is. But none of this is unbeknownst to anybody that's paying attention, including folks in Washington. And unfortunately, I don't think it's going to send the signal or the message that Moody's is intending to send. So, no, I don't think it changes much in terms of the budget debate. Even more importantly, perhaps, I don't think it changes much in the direction of the Fed in terms of catching up with the rest of the world and making appropriate adjustments to monetary policy and bringing rates down sooner. Jay Powell's not going to see anything in this and go, maybe I need to put my foot on the gas a little harder. I don't see that happening either, unfortunately.
Yeah, I think you're right about that when it comes to the Fed. Let me ask your take on, it does seem like it's obviously been a very headline-driven market, and last week it was all about the progress that we made on the trade front. It started with the Friday before, this past Friday, with the U.S.-UK framework of a deal, and then the Monday news that we got on China-U.S. 90-day, ratcheting down of tariffs. Does it, in your view, is this continue to be a headline-driven market, whether we're talking about this latest move from Moody's or trade?
Yeah, it's definitely, we around my firm, we call it a tape bomb market. And I think that's actually going to continue even after we get resolution with some of these trade wars that President Trump has started. And in fairness, Diane, I'll take the other side of the coin here. Great news when it comes to the progress that was made. We got 90 days in which to make a deal. So it's going to be all about what are the details, what are the contexts and the contours of the non-tariff trade barriers, things like intellectual property, artificial market stimulus, questionable monetary policy on the part of the Chinese government. President Trump and his team have to deliver. And by the way, they not only have to deliver on China, but they also have to deliver on India, Japan, other key trade partners. I think there are deals that are already sort of done and dusted, and they're waiting to release that information strategically, but they have to deliver. This was good news, but the market's patience for this does not have an unlimited fuse. I can promise you that.
Is the market's patience essentially within this 90-day period?
Well, I think it's actually probably shorter than that, Dan, right? Because a lot of respected economists essentially said, look, we've got perhaps until the spring, mid-June, et cetera, before the impact of some of these trade policies, these very draconian tariffs, start to filter their way down into the economy, start to filter their way down into earnings. Everyone celebrated last week's PCI. I thought that number was terrific because it was statistically relevant in terms of how long it has been since we saw a decline like that, going back, of course, to the beginning of Chairman Powell's commencement of the fastest change in monetary policy in U.S. history. Not because we didn't see the impact of the tariffs. There wasn't enough time to see the impact of the tariffs in that PCI print. Let's be honest. So this is not an unlimited runway to get these trade deals done. And the market, I do not think, is going to be terribly forgiving. We're watching that VIX, Diane, that fear gauge.
Yeah.
As soon as we see it start creeping above a 20 handle and get higher, then we start to worry.
All right, well, it's just below 20 right now, around 19 right now, so we'll certainly be paying attention to that.
Yep.
All right, Marc, thank you so much for joining us this morning. That's Marc LoPresti, CEO and Senior Market Strategist, Market Rebellion.